In today's episode of the MSA Rental Market Update, we are looking at the Chicago rental market for conventional multifamily properties. You can see, kind of see how the Chicago metro statistical area is drawn, and I will scroll in a little bit here in a second, give you an idea where this market is, although I would have to believe most people do know where it is located. We have Minneapolis, Minnesota up here. Here's Green Bay and Milwaukee, Wisconsin. Detroit, Michigan, Columbus, Ohio, Pittsburgh, Pennsylvania, Louisville, Kentucky, Indianapolis, St. Louis, Kansas City, Nashville's down here. Of course, we have Washington, D.C., Philadelphia, New York City over here with Buffalo and Toronto over here, and the Canadian border. Well, that was a quick geography lesson. Let's scroll in a little bit to Lake Michigan here and kind of see how this metro statistical area is drawn out. And as we can see, thank you, CoStar, for doing that for us, that the metro statistical area dips into Indiana. So we have the Indiana state line right here, and you can kind of see the Indiana state line over here as well. And that metro statistical area dips into Indiana as it goes down into Gary and other areas and goes all the way up into the very southern area of the Milwaukee area, encompassing the very southern part of the Milwaukee metro statistical area. So this gives you an idea of where this is located. If we come over here to our filters and see that we are excluding all corporate, all military, all senior, and all vacation, and we are only including market and market affordable. Once we get to the end of this session today, we will look and see where the Chicago metro statistical area is on the market cycle chart. So let's start by going and taking a look at the analytics for all three asset classes combined. Here is the rent analytic data for the Chicago metro statistical area. There are 21,245 properties totaling 561,438 units. There is still 16,746 units under construction, and in the last 12 months, 5,631 more units rented than went vacant. In the prior 12 months, 18,413 more units were rented than went vacant. And interestingly enough, even with that slowdown in absorption, we have been stable at 5.5% vacancy rate in the last 12 months. The Chicago market does have a slight year-over-year increase in rent of 4.3%. And we are not looking at the capital market. We are just looking at the space market. If we scroll down, look at our long-term occupancy average, this market likes to be at 93%, and it is currently sitting at 94.5%. So above that long-term occupancy average. If we go back to that cycle chart again, it looks like we are somewhere above this line right here. So that said, let's go take a look at the data and see what the data is telling us for all three asset classes combined. So here is the rent analytic data for all three asset classes combined in the Chicago metro statistical area. We are not looking at asking rents. We are only looking at effective rent. We don't care what the owner is asking. We care what they are collecting. If we look in the first quarter of 2022, it was at $1,584, went up to $1,632, and then we had a little break here, which is interesting considering our vacancy was stable. So between second and third quarter, it went down to 1622 and then down to 1616. I got to be honest, I didn't expect that. So let's take a look and see what deliveries and absorption tells us. So if we look at deliveries in first quarter, we had 2,487 and more units absorbed than were delivered. So 2,487 vacant units were delivered to the market. And not only did those 2,487 absorb, an additional almost 400 units were rented on top of that. Even better, we had 1020 deliver in the second quarter and a staggering 3,544 units absorbed taking that occupancy all the way up to 95%. Real strong occupancy in the market. Then we had 1,527 deliver and only 979 absorb. Ticked down to 94.9, but we're still 0.4% above where we were in the first quarter. Then another 1,252 delivered, and an additional 10 units went vacant. But again, we're still above that long-term occupancy average at 94.5 to 94.7. So we're still above it. So that is the reason. Of course, we go into the first quarter of 2023, which I'm not looking at because of erroneous information that we've seen in a lot of markets. That's where we get that stabilized 5.5% vacancy from the last 12 months. So that explains that. It went all the way up to 95 and then kind of settled back down to where it was in the first quarter with the deliveries and absorption now slowing. So deliveries aren't slowing, but absorption is. So let's take a look at each individual asset class, and we'll look at the Class A first and see what story the A class is telling us. So here is our Class A rent analytic data. There are 370 properties totaling 79,068 units. Looking at effective rent, in the first quarter it was at $25.84, went up to $27.13, and as with the all asset classes combined, we had the drop between the second and third quarter to $26.48, dropped again to $26.05. If we scroll over and look at deliveries and absorption, we can see that much less has delivered in Class A. So it looks like the Class B is the strong deliveries. We had 431 in the first quarter with 777 absorbing. That's good, strong absorption. 404 delivered, 1427 absorbed. So again, that 3 times the amount absorbed. So first and second quarter really strong in the Chicago market. Then in the third quarter, we had 305 deliver and 243 absorb, still within that 80 percentile. Then we had 285 deliver, and then another 192 went vacant. So where we started the year at 92.2 in occupancy, we ticked up to 92.9 because of that real strong first and second quarter, but we've definitely slowed down to an actual crawl where we're actually going negative now in the fourth quarter. So very interesting. That is the Class A market. We definitely see that slow down. Don't really understand why we saw that tick down in rent in the third quarter, but definitely why we saw it in the fourth quarter. So let's go see what story the Class B is telling us. Here is our Class B rent analytic data. There are 4,608 properties totaling 191,928 units. Looking at effective rent, the first quarter of 2022 was at $15.57, went up to $15.99, went up to $16.03, and pretty much stabilized at $16.01. I wouldn't call this a break in rents. It's only a $2 difference. I'd call that stabilized. Let's see what deliveries and absorption tells us. We had 1873 deliver in the first quarter and 1402 absorb. So pretty decent absorption, somewhere between 75 and 80%. So not bad there. Then, as with the other ones, we got 3 times the absorption, 419 deliver and 1401 absorb. So 3 times more than delivered. Then 1108 delivered and 789 absorbed. So we had that slow down once again. Then 953 deliver and 307 absorb. So pretty big slowdown between the between the third and fourth quarter, yet the rent stayed pretty stabilized. But if we can look at this and say, okay, well, we're right on that long-term occupancy average. We're right around that 94.5% occupancy or 5.5% vacancy. So that does make a little bit of sense as to why we really haven't seen those rents break yet in the Class B market. So moving forward, if it continues to stay slow like this, with this slow absorption, we will definitely start to see this occupancy tick down and these rents will start to trend down. But right now it looks like the rents and occupancy seems to be holding, at least for the moment, in the Chicago metro statistical area for Class B properties. Let's go see what story the C's are telling us. Here is our Class C rent analytic data. There are 15,528 properties, totaling 285,830 units. If we look at effective rent, it was $1,160 in the first quarter of 2022, went up to $1,179, stabilized at $1,181, up to $1,187. So we are climbing in rents, although stable between second and third quarter. Let's see if absorption tells us the same story. So I'm going to discount these deliveries and under construction for Class C. These are probably in bad neighborhoods, and why they're being said as delivering to C's. You don't deliver C product to the market. They come to at least B's. So 668 absorbed. So good, strong absorption again between the first and second quarter, as with the A's and B's. And then, of course, then the exodus starts at 52, negative 52. So 52 more units went vacant than rented in the third quarter, and 126 more units went vacant than rented in the fourth quarter. But as we can see, we still have really strong occupancy. So we're only at 4.7% vacancy. And so we cannot discount the fact that the owners still believe that we have really high occupancy and that we need to drive this down a little bit more before we start breaking on those rents. And I would tend to agree. So occupancy still holding strong, although is showing the lack of demand at this point. As this continues to trend downward, that will put more pressure on rents as occupancy goes down. But for right now, at least in the B and C class, it looks like rents are holding stable. And in the A class, we had that little bit of a break. So what does that look like for the overall market? We were at 94.5. Long-term occupancy average was around 93. So what that tells me is if the long-term occupancy average is 93 and we're at 94.5, we could pretty comfortably put the market either on this first or second point. Honestly, I'd say this first point because we're really not seeing the break in rents yet. We are starting to see some weakness in absorption, especially in the Class C's. All three asset classes were negative in the fourth quarter for absorption, but it is just starting to break. So I'd plot it right here on this first point in oversupply for now. We'll see what it looks like when we get the first quarter data for 2023 and see if it moves down to here. But right now I'm pretty comfortable putting the Chicago MSA right there on that point. So that concludes the Chicago metro statistical area. Stay tuned tomorrow as we head south to Lake Charles, Louisiana. I will see you guys tomorrow.